Guys, you've heard me say this before. The stock market is crazy right now with some overvaluation that's absolutely massive. But there are still some great undervalued companies for you to buy and make a ton of money when the market sees their true value. But remember, we're not here to tell you what to buy. We're here to teach a process. And today we are diving into something that's all over the internet right now. What stocks to buy and what stocks to sell. So now we're going to take these 6 stocks, run them through the only filter that truly matters, valuation, not headlines, not hype, not emotion. We're going to focus on the numbers. We're going to pull the story into the numbers, but we're going to figure out what is the company's intrinsic value and look at that compared to the price today. That process will tell us which of these names could be potential buys at the right price and which ones are better off avoiding or selling altogether. Because great companies don't automatically make great investment. It all comes down to what you pay. Now, guys, I cannot repeat this more than ever. Never, ever buy a stock because anybody on the internet has it or says to buy it. Even if Warren Buffett has it. We're here to teach a process. I'm going to evaluate these companies based on the way I see them. But remember, your goals and my goals and your way of viewing companies and my way are very different. But our process should be very similar in terms of how we value businesses. So in this video, I'm going to teach you how I value stocks, what I consider to be the right way, so you can make your own confident decisions as an investor. And if you're new here, well, of course, welcome. You're going to hear me say things that you have never heard on YouTube before. Stock number 1. This is quite the crazy stock right now, AMD. The big chip maker, the CEO of AMD and the CEO of NVIDIA are cousins. Now, this stock fell over 17% after posting earnings this month, not because the business collapsed, but because expectations were sky high after over 100% plus return and guidance wasn't perfect. Guys, this is exactly what I've been talking about on this channel over the last 5 years. When stocks are priced for perfection, where all the growth, all the opportunity, and the future potential are already baked in, it leaves very little, if not zero, room for error. Then earnings come out, guidance shows even a temporary slowdown or expectations aren't perfect, and guess what happens? The stock gets absolutely destroyed. This is why price matters and why you have to be extremely careful about what you pay for a stock. Now remember, the price matters relative to the value. We're here to determine what is the value of every individual share of these companies. Now back to AMD. Despite the recent earnings, AMD is projecting roughly 60% annual growth in data center revenue, with AI expected to drive tens of billions in sales over the coming years. Just a few months ago, analysts were saying AMD today looks a lot like where NVIDIA was a couple of years ago. And funny enough, as I said before, CEOs are cousins. Now, I'm not saying AMD is going to dethrone NVIDIA tomorrow, but our job is to find out if AMD is selling at a great price or not. We are going to factor in that future potential growth. But remember, if you factor it in like it's guaranteed to happen, you're going to make mistakes. Prime example, look at Tesla. Just a few short years ago, the idea of saying Tesla would have a decline in sales was unfathomable. And now look at it. People have turned completely on Elon Musk, and they are losing market share like crazy. That was not thought. I remember people saying, even 6-7 years ago, I would never bet against Elon Musk. Well, guess what? People are doing that right now. So let's look at AMD here. $355 billion market cap. That's buying every share outstanding and owning 100% of the shares. Now, we got to compare that to enterprise value, $363 million. This $9 billion difference is essentially their net debt. Now, why is that important? Well, guys, last year they did $5.5 billion of free cash flow. So less than 2 years worth of cash flow can pay off all their net debt. That is awesome. Okay, let's go to some margins. Now, I'm actually surprised by this. What I'm happy to see is 10-year profit margin, 8.5%. 5-year profit margin, 10%. Last year's profit margin, 10.3%. So it seems to be getting better every single year. Their gross margin, 48%. That means every unit they sell, 48% of that money goes to the bottom line before taxes and overhead. That's pretty good. As that number gets higher and higher, and remember, right now, this AI chip stuff is in hot demand, so this number is going to be high. But if that can continue to get better, this bottom line profit number will get better along with it. Remember, when Intel, for many, many years, was running 20 to 22% bottom line profit margin, that's over double what they did last year alone. So there's a lot of potential still with AMD here. Now, one thing I don't like, returns on capital are absolute shit. 3%, 2%. Now, what's return on capital? Well, guys, when you invest in a business, you either borrow money from people and you invest, or you take equity, either your own or other investors, and you put the money in. The return on capital is that return generated on both the debt and equity that's raised for a company. Companies that have high returns on capital, like 10% or more, are considered very good capital allocators. They take their money and they invest it well. That's a sign of a good company, a great company, and that's why companies with high returns on capital get a premium. Well, AMDs are they're not very high returns on capital, so it might mean discount there. All right, let's see what else we got. Great revenue growth, 22% a year for the last 10 years, 30% a year for the last 5, 3% a year for the last 12. And guys, their acquisitions are very low, so this is all organic growth. That is incredible. All-time high, $267 on October 29th, just a few months ago. And look at it now. It's at $216. Actually, not as far off. Only $76. Wow. From April of last year to October, it went up from $76 to $270 per share. Our community members have it as a hold right now. Let's check out the 8 pillars. A lot of X's here. High PE, high price to free cash flow, not good returns on capital, and here's a big one, guys. The silent killer in investing. Shares outstanding up 33%. So guys, what they're doing here is they are diluting shareholders. What does that mean? In order to raise equity, in order to raise money, like I said before, they're issuing shares out there. Well, that's a bad thing, and here's why. Let's say a company has 10 shares outstanding. You own 1. You own 10% of the business. If they increase their shares by 33%, they're going from 10 shares to 13.3 shares. You still own 1. But now you own 1 out of 13.5 shares, not 10. Your ownership went from 10% down to 7% or 7.5%. That's dilution. You did nothing but sit there and wait and be patient, and they punished you for it. Now, guys, I've thrown a lot at you. If you're new to the channel or you're new to this kind of investing, it's going to feel overwhelming, and I just want you to know everyone feels overwhelmed. Everyone does. Warren Buffett at some point did. Munger did. Every great investor did not come out of the womb going, I get returns on capital. I understand dilution. It doesn't happen. Luckily, I created a cheat sheet, absolutely free, that you can download. It'll go through all these key metrics, explain them to you, tell you why they're important. So click the link below, download the cheat sheet. We will send it to you immediately. That way you have this tool. As you look at companies in the future and as you listen to our videos, we're all speaking the same language. I assure you, if you're able to understand these, this will put you in front of 99.9% of investors out there just by understanding these metrics. Now, in a couple minutes, guys, we're going to go over the right price to pay for this company, but let us go to analyst estimates real quick. Wow, look at this growth. Analysts expect $6.35 per share this year in profit, growing to $16.76 in 2029. Guys, let's say you applied a 20 PE to this. That makes the stock $330 a share. The stock currently at $215. That seems like pretty decent upside for a company with that kind of growth. Revenue growth, look at this. 27%, 37%, 39%, 20%, growing from $42 billion to $97 billion. Now, remember, priced for perfection. I'm not saying they're wrong, but if you invest in everything based on perfection, any sort of hurdle will cause a massive problem. Look what happened the other day. They reported bad guidance for the future. The stock fell 17%. So we take all of this information, we put it together, and we go to the stock analyzer tool. The great thing about the stock analyzer tool is it allows us to merge the story and the numbers together. We use the story to put revenue growth numbers in, profit numbers in, PE, price of free cash flow, and our desired return. And it tells us, based on these assumptions, what is the right price to pay. Guys, Main reason I teach on YouTube is I was sick of hearing people just talk about the story. And I always say to people, if you focus on the story is the same whether this stock is 216, 2160, 21,600, or $2. That's not investing. In true investing, the share price changing will change whether it's a good investment or not. Yes, the story matters. It's going to dictate the assumptions you make. That's what we're doing here. So, what assumptions did I make for the next 10 years on AMD? Well, first off, I put in revenue growth of 8, 16, and 24%, which I still think is very high, by the way. Profit margin, I did 8, 15, and 22. And again, look, guys, their free cash flow was 17% last year, which is great. But apart from that, they've never done 15% in the last 10 years on free cash flow or profit. So I'm giving it pretty high assumptions here. PE, I put 18, 21, and 24, even with these low returns on capital. Why? Because their growth potential is very, very big. And then finally, what's my desired return? Well, guys, I only put 9% in here to get my intrinsic value. Remember, I'm not trying to buy for intrinsic value. I want margin of safety. So when you're doing this, for those of you who have the software, put in a higher number than 9%. What's that number? Depends on how you feel about AMD. Do you feel good about it? Do you not feel good about it? What kind of margin of safety do you want? It all depends on where you are. Do you already have a position in it? Do you have a max position in it? Should you buy more? These things adjust your margin of safety, desired return. So I hit the analyze button. Guys, I have a low price of 40, high price of 450, middle price of 150. So right now I'm a little cautious. Now, if you're out there and you've made assumptions that make it a lot better or a lot worse, I'm cool with that. That's the thing. That's what makes investing an art. Now, what I want everybody to remember is most people lose money when they buy stocks because their big obsession is picking the winners. But the best investors think differently. They focus on eliminating the losers first. That's exactly what we're doing here when we analyze a stock. And big key here, the big and is the most common way people eliminate losers is not overpaying. It's amazing to me that people focus on the story so much more and they'll pay any price for that story. I don't buy into that. The best investors realize that there is the wrong price to pay for a great story. Now, stock number 2, PayPal. Guys, this one got hit hard also out of earnings. It's trading near a 52-week low after the market absolutely punished it just a couple of weeks ago for a weak fourth quarter and soft guidance for 2026. The stock dropped 20%, and Wall Street immediately started screaming, "Is this a value trap?" Remember, we're investors, not speculators. Price falling doesn't mean value disappeared. PayPal still throws off significant cash flow. They're committed to massive share repurchases, and they own powerful assets like Venmo and Buy Now, Pay Later that are far from fully monetized. Now, they did just hit the reset button again, appointing Enrique Lores as president and CEO effective March 1st, replacing Alex Chris as the board looks to accelerate performance and bring steadier, more experienced leadership to a company that needs sharper execution. The question isn't whether PayPal is exciting today. It's whether we're being paid enough at this price to wait for the turnaround. Now, guys, I want to be very clear about something. The last 5-year free cash flow average was 5.17, and this last year they did 5.57. Think about that for a second. The stock was at $310 a share in 2021. Let's look at the cash flow statement. In 2021, they did free cash flow of $4.89 billion. Last year they did 5.57. The stock was at $310, now it's at $40, and the free cash flow is better. Yet we're beating this company up right now. Why is that? I'm not saying it means that you should go buy PayPal. What I'm trying to sit there and say, remember, I own PayPal and don't buy it just because I own it. But my logic is this the example of news following the stock price? The stock is down a lot since its all-time high, and people look at that and think, bad. I look at it and think, well, if people loved it at 310 and their cash flow is better, yeah, it could be a falling knife. It could be something where the business is getting worse. But if the business is getting much worse, revenue's up. Let's look at their revenue numbers. Yeah, it's not up a ton, but it's up 32.86 versus 31.8 in the full 2024. And look, every year revenue is going up. Yet since it hit $310 a share, Revenue's up how much? 30%, and they're still sitting there saying the company's dead and dying. Might be. I'm not saying that's wrong, but I'm sitting there saying if you loved it at 310, why wouldn't you do anything possible to have it at 40? I'm not saying to do that. What I'm saying is that's the way I want you thinking, because most people don't think that way. Let's look at the 8 pillars here. It should be an 8-pillar thriller. It is. Everything's a check mark. High returns on capital, bought back 20% of its share, cash flows up, revenue's up, net income's up, selling for single-digit 5-year PE and price of free cash flow. Man. Listen, I don't know the future. None of us know the future. That's what makes investing very difficult. I look at the saying, if I had 30 examples of this, and we're going to pull up stock analysts. Let's look at analysts and see what they have to say. Look at analysts. They have $595 in profit this year, growing to $923 in the next 3 years. My mouse is going haywire here. Revenue, 6% growth, 6.8, 6.4, 7%. Listen, they could be wrong. Analysts are wrong all the time. I get that. But I'm looking at it going like, why is everybody, and I look at it going, the reason why everybody's upset about it is the stock was at 310, now it's at 40. So let's go run our stock analyzer tool on this. Let us pull up PayPal. Boom. Guys, 10-year assumptions. I did 3, 5, and 7% revenue growth. Profit margin, free cash flow margin. I'm focusing on free cash flow. It's much higher than profit, which we love. I put 16, 19, and 22%. PE and price of free cash flow. Increasing returns on capital. Venmo's a great option. It's a great utility. When it comes to safety of payment, I look at PayPal for myself. I put 16, 19, and 22. And again, my 9% desired return. I hit the analyze button. The stock's currently at 41. Guys, I have a low price of 70 to 87, a high price of 145 to 200, middle price of 100 to 133. Major upside here, if I'm right. Now, the whole point is, I don't know if I'm right on PayPal. But my point about all this is if I could find 30 companies priced like this kind of returns, I'm going to do very, very well. That's the key here. We don't know if we're going to be right on any individual company. That's why I like diversifying into undervalued plays. Now, before we go any further, I want to make one thing very clear. This video isn't a standalone video. It's part of a journey we go through every single month together on this channel and all year long. We're consistently digging through the market to find mispriced stocks, identify opportunities, and avoid the overpriced landmines that can destroy returns. To get the full picture, you need to follow the entire process, not just one video. So make sure you're subscribed and watching every video because this is a journey we're going to take together. Guys, when you look at Steph Curry, when he goes out to shoot threes, where does he start? He starts 2 feet from the basketball line just to get a stroke in every single game, every single practice session. Successful and being good at anything in life isn't about just immediately replacing the basics. You hear all the time when coaches say, we got away from the basics. I want you guys to remember this. It's all about repeating this over in your head at all times. All right, third stock, Netflix. Now, guys, this is a stock that I was critical about for a long time, and I think I was just plain wrong on this one for quite a while. Now, this one is that great lesson in valuation and risk. Now, guys, the stock price fell nearly 39%, almost 40% from the highs of 2025 because the market freaked out over their proposed $82.7 billion acquisition of Warner Brothers Discovery assets, which could load the balance sheet with tons of debt and execution risk. Even though the core business is still strong, with ad revenue expected to double, margins pushing north of 31%, and revenue projected to grow about 13% in 2026, the uncertainty around this deal has shifted the narrative from growth to risk. And I don't blame people, guys. It's a lot of debt in those companies. A lot of those media companies have tons of debt, and it kind of becomes a slodge to get through it. This is another reminder that a great business can become a bad investment if you pay the wrong price. Now, I'm going to be honest with you. I'm really excited to look at Netflix after this decline and its most recent earnings. It's actually sitting near a 52-week low. So what we're going to do is we're going to strip away as much noise as we can. We're going to ignore as much fear as we can. And we're going to see if the stock is finally selling at a price that turns a great company into a great investment. Because that's the sweet spot we're always looking for. Great business, great price. So, year to date, the company is down 10.5%. It's $350 billion market cap, enterprise value of 3.72, that $20 billion of net debt, and they made $9 billion in free cash flow last year. Guys, this is why I don't like the whole tons of debt for Warner Brothers. That doesn't mean they don't have good assets they should buy, but we got to, debt really becomes, I don't remember many companies that loaded up on debt for long periods of time that became better. If anything, I see the exact opposite. When you live and breathe with debt, you die with debt. You should be able to run a great business without having tons of debt, except for certain businesses like real estate and things like that. All right. We got a 24% profit margin. Last 10-year average is 15.5%. 5-year was 18%. So you can see that profit margin is getting better and better, which is awesome. Growth rate, 21% a year for the last 10 years, 12.5% for the last 5, 11.5% for the last 3. So still a growing machine. Let's go see. And by the way, our community members have it as a hold right now with an average intrinsic value of $65. Current 8 pillars, everything's a check except for valuation. But remember, these are 5-year numbers. And look at the 5-year free cash flow, $4.5 billion. It's double last year. So these numbers are a little misleading. It's still expensive, 40 times free cash flow and 33 times earnings. But remember, if a company is growing like crazy, they can justify these valuations. If I told you that Netflix was going to double its profit for the next 20 years, you would pay 100, 200 times earnings all day long because it's going to be so cheap relatively soon. So let's see what analysts are saying. $3.30 per share this year, going to $5.39. That's 27, 19, 18, and 16% earnings growth. And the revenue growth, 13%, 11%, 9.5, 9.5. Guys, a lot of potential here. A lot of great potential here for this company. And it's a great company. When it comes to streaming, it's the first app I go to. All the other apps that I go to, I only go if I hear about a show I should be watching. But for Netflix, I will go browse there. So let's go to our stock analyzer tool. Let's punch in Netflix. When was the last time I did Netflix? Earlier this year. So guys, I have a 10-year analysis. I did 7, 9, 11% revenue growth. I did profit margin of 20, 23, and 26, and a slightly lower free cash flow margin, 19, 22, and 25. Because as you can see, the gap between free cash flow and profit is narrowing here. It used to be 10%. Then it was 5%, and now it's down to less than 4%. It's like 3.5%. So that gap is narrowing. PE, 10 years from now, I put 20, 23, and 26, and again, my 9% return. The stock's currently at $81. I have a low price of a little under 50, high price of 100, middle price of around 70. So guys, I'm still waiting for a better time to buy, in my opinion, on this company. Look, guys, the truth is that most people are going to lose money with stocks because they don't have a plan. They buy the wrong companies, or, and this is what's more common, they buy the right companies at the wrong price because of hype. They sell it completely the wrong time because of fear. I used to do the exact same thing for years, and it really felt like the market was rigged to take my money. That was until I learned how to invest the right way. This is exactly why we built Everything Money, to help regular people like you stop guessing and start investing with real confidence. You're going to get our stock analyzer, our tools, our courses that teach you step by step. You're finally going to see the stock market through the lens of success, not fear, through the lens of an investor, not a speculator. Try it for 7 days. You'll see. This isn't gambling. It's common sense. Now, our fourth stock is actually trading at a 52-week low. And remember, I truly believe that 52-week lows are a great place to start looking for mispriced value. Clearly, it's not a guarantee, but often this is where fear pushes stocks below their intrinsic value. Adobe is down over 40% from its highs as investors worry about generative AI and its possibility to disrupt the creative cloud dominance and compress margins due to heavy AI infrastructure spending. The market is basically asking, is AI a threat to Adobe, or is it the next growth engine? Adobe still throws off massive cash flow and owns a dominant ecosystem, but the key question for us is whether the current price more than accounts for those AI fears. This is exactly the kind of setup where valuation, not emotion, will tell us whether Adobe is a falling knife or a long-term opportunity. So guys, Adobe, like I said, generates a lot of free cash flow. $10 billion last year. Now, guys, we've had AI be huge for the last 2 years. Here's where I question the AI affecting Adobe's business. The last 5-year average free cash flow was $7.8 billion. Last year, last 12 months, almost $10 billion. Again, it could be still in the early stages of changing things, but how could cash flow be that much greater? If you want to go look at it by year, let's go look at the cash flow by year. Right down here, 6.8, 7.4, 6.9, 7.9, 9.85. And the what's it called? AI has been a big deal all throughout this. So I'm looking at this going, okay, it's not screaming, but again, it could be something different. Another thing that's great is the free cash flow is greater than its net income. So people are going to focus on net income. We're going to focus on cash flow. And it's currently selling for 11 times free cash flow. The all-time high in the stock was $699 back in November of 2021. It is now at $258. Analysts expect growth of earnings 12%, 12.5%, 6.5%, 9.5%, 9%, and revenue growth of 9.25%, 9.25%, 7.5%, 8%, and 7.5%. Again, they could be wrong. A lot of people could be wrong, but remember, people tend to over-dramatize these things. And look at our 8 pillars here. All 8 pillars are a check mark. They're buying back shares. This is a great thing to do. So, what's the stock worth to us? Well, here are my assumptions that I did last. 4, 7, and 10% revenue growth. I'm focusing on free cash flow, 38, 40, and 42. And look at the free cash flow. It's pretty steady in the last 5 and 10 years and up in the last year. What PE for the last 10 years, for 10 years from now? Its returns on capital are getting better. I'm putting 18, 21, and 24, and again, my 9% return. The stock's currently at 257. Guys, look at this. Low price of 398, high price of 850, middle price of 583. Huge upside here if they just continue on this path of steady growth. If you believe that AI is absolutely going to remove Adobe, then avoid it. If you think it's maybe a little too overrun, it's an opportunity to look at. Now, stock number 5, let's look at Palantir, because this one perfectly highlights the difference between an incredible business and an expensive stock. Palantir has pulled back about 22% from its early 2026 highs, not because growth slowed, but probably because valuations got stretched after a massive 135% run in 2025. The company's firing on all cylinders with revenue up 70% in Q4 and guidance calling for roughly 61% growth in 2026, driven by explosive demand for its AI platform. But when a stock is priced with little margin for error, sharp pullbacks can happen. Palantir may be a one-of-one business, but the real question for us isn't how great the company is, it's whether today's price still makes sense for long-term investors. So, let's pull up Palantir here and see how it's looking. $344 billion market cap. One thing I want to show you guys, look at this enterprise value. They essentially have no debt, actually more cash on hand than debt. Free cash flow is up a lot. 5-year average, 730. 1 year is 1.8 billion. And look at their net income, 1.1 billion, and 5-year net income of 130. So like Adobe, way more cash flow than net income. Look at this gross margin, 81%. Every extra dollar they bring in, 81% is gross margin. 28% growth in revenue for the last 3 years, 31% a year the last 5 years. Their return on capital has turned positive. I mean, the all-time high is 207. It's currently at one. Oh, wow. I didn't even realize that. All-time high, guys, was just 3 months ago at 207. Now it's at 134. Yeah, the community has it as a sell here. That's a pretty rare thing, but you got the 8 pillars here. Check marks in all the fundamentals in terms of cash flow, net income, revenue growth, low debt. But they've shares outstanding up a lot, 31%. And I don't blame them. People want their stuff. Look at this growth in earnings. $1.03 per share growing to $3.29 according to analysts. And revenue growth, 41%, 38, 35, 42, 30. All right, so what does that mean for the stock? What its value is? Now, guys, I was a little more conservative on the revenue growth side. I did 10-year analysis. I did 12.5%, 20%, and 27.5% revenue growth. I put profit margin and free cash flow the same of 35, 45, and 55%. PE 18, 22, and 26. And again, my 9% return. The stock's currently at 134. This is why I'm worried. Low price of 20, high price of 122, middle price of 50. And again, this assumes no dilution, no extra dilution, no extra shares outstanding. Guys, this to me is a big concern. I just look at this going, man, I'm not touching this with a 10-foot pole. Now, last stock, another internet business, Google, the googly moogly. This stock has been on a tear. Last up is Google, and this is a classic case of a market reacting to fear based on earnings, not necessarily falling fundamentals. It's up 67% in the last year. Year to date, it's even, but as of late, it's fallen 6 or 7% because of earnings. It's been very volatile as investors focus on massive AI-related capital spending and ongoing regulatory pressure, even though earnings and core revenue growth remain strong. The concern is that pouring billions into data centers and AI infrastructure could pressure margins in the short run. But Google still dominates search. Google is seeing strong momentum in their Google Cloud service, and they generate enormous free cash flow to fund these investments. Once again, this comes down to valuation. Oftentimes, the market just gets it wrong. So let's marry the story with the numbers to figure out what price I would want to buy Google at. So guys, $3.82 billion market cap, very similar enterprise value, $73.5 billion of free cash flow. Now keep in mind, look at that net income, $125 billion versus free cash flow. They're spending a lot of money on capital expenditures. So this is going to be a lot lower than the net income for a while. It's selling for 30 times earnings, 57 times free cash flow, great margin, gross margin of almost 60%. And look at this, profit margin increasing over the years. 25% a year for the last 5 years, 25% for the last 10 years, 27% for the last 5 years, and 32% last year. Guys, big time stuff. 8 pillars. I bet I know what this looks like. 6 checks, 2 X's, and the X's are valuation. But can they justify that valuation? That is the question. Analysts think the profit's going to go from $11.27 per share to $17.75 per share. That's growth of 15% a year, essentially. That's a lot. And revenue growth? See, this is what it surprised me. I thought the profit margin would be much bigger growth because revenue alone is growing 11 to 13%. That's a lot of revenue growth. And for a company like this, and they can keep increasing their gross margin, that should make the profit much higher as time goes on. Now, if you want to see companies that fit my process right now, I picked 7 stocks last year that I believe will beat the actual Magnificent 7 for years to come. And I'm going to be honest, 2025 results were not what I expected. You're going to want to see how things panned out. So you can click on the video right here to check it out. Thank you for your time.